In this video we are going to talk about monthly dividend stocks that will pay your bills. So before starting this video, please like this video and subscribe to this channel for our future updates. Monthly dividend stocks provide investors with the opportunity to earn periodic passive income from their investments. This frequency is more in line with the frequency of many regular invoices, allowing an investor to offset some of their outgoing expenses with dividend income. Monthly dividend stocks may be particularly tempting to retirees and other investors who rely on their portfolios for income. Number 1. Agree Realty. Real estate investment trusts, REITs, such as Agree Realty, are ideal monthly income stocks to invest in since they provide recurring rental income. The company holds freestanding retail properties that are leased on a triple net basis, which means the tenants are liable for all property expenditures, such as insurance, maintenance, and real estate taxes. While Agree Realty is a newcomer to monthly dividend payments, it switched from a quarterly to a monthly payment schedule in January 2021. The firm has a strong long-term dividend track record. Over the last decade, this real estate investment trust has increased its dividend at a compound annual rate of 5%. This upward trend is projected to continue as Agree Realty continues to expand its portfolio. In 2021, it plans to buy up to $1.4 billion in real estate, boosting its rental income and dividend-paying capacity while lowering its debt. Agree Realty has a strong balance sheet, which will help it fund its future expansion. Number 2. Gladstone Land. Gladstone Land is a real estate investment trust, REIT, as well, REIT. They specialize in purchasing real estate and farm-related assets, which they subsequently lease to farmers on a triple net basis to create money. Because healthy goods like fruits, vegetables, and nuts are less price-sensitive than commodities like corn, wheat, and soy, the initiative focuses on farms that grow healthy foods like fruits, vegetables, and nuts. Gladstone Land has a lengthy history of paying out dividends to its shareholders. The REIT has increased its dividend 23 times in the last 26 quarters, resulting in a more than 50% rise in the amount paid out. For the foreseeable future, it expects to grow its monthly dividend at a rate that is higher than the rate of inflation. The company's growth is fueled by steadily increasing rental income from existing farms, which is boosted by annual rent increases, as well as a steady supply of new farm acquisitions. Gladstone purchased 13 farms and over 20,000 acre-feet of banked water in the area for $80 million in the second quarter of 2021. These investments allowed the corporation to expand its agricultural portfolio, while reducing the risk of drought-related losses on certain of its farms. Number 3. EPR Properties. Another REIT to consider is EPR Properties. It focuses on owning experiential real estate like movie theaters, eat-and-play restaurants, ski resorts, and gambling facilities in particular. It acquires these locations by entering into triple-net leases with the entertainment venue operators. The COVID-19 pandemic had a significant impact on the experiential real estate business. For a time, several of these establishments were compelled to close their doors or operate at a reduced capacity. They were unable to pay their rent as a result, and EPR Properties was forced to stop paying monthly dividends last year. With the widespread availability of vaccines, however, more people are regaining the bravery to engage in activities outside the home. As a result, tenants at EPR are catching up on their rent payments. It was able to do so in time for the REIT's monthly dividend to be reinstated in July 2021. Even though EPR Properties presently provides a competitive return, if its portfolio of properties grows, the REIT may be able to improve that payout in the future. It had over $500 million in cash and a $1 billion credit facility that had not been called down at the start of 2021, allowing it to go shopping for more experiential real estate. Number 4. Pembina Pipeline. Pembina Pipeline is a pipeline construction company based out of Canada. The corporation manages pipelines, processing units, storage terminals, and export facilities. Its main business is leasing the ability to operate its assets to other energy companies under long-term, fixed-rate lease agreements. As a result of these collaborations, Pembina is able to generate stable cash flow, and the firm has a robust dividend history, having grown its payment year after year throughout its history. It should be able to keep increasing its dividend in the near future, given that it has completed more energy infrastructure expansion projects. It has a substantial backlog of secured contracts and many more in the development pipeline, allowing it to boost dividends in the future. In addition to continuing to support fossil fuel transportation, Pembina is investing in programs that minimize carbon emissions. To supplement its wind energy resources, it is cooperating with another Canadian energy infrastructure business on the creation of a carbon dioxide transportation and sequestration system. It's also looking into hydrogen's prospects. Number 5. Realty Income. When it comes to monthly dividend stocks, Realty Income is without a doubt the greatest. It will have paid 615 straight monthly dividends by late 2021, garnering it the nickname the Monthly Dividend Company. Since its initial public offering, IPO, in 1994, Realty Income has increased its dividend 112 times, including each of the last 96 quarters. This gives this REIT over 25 years of dividend increases in a row, earning it the title of Dividend Aristocrat in the eyes of the investment community. In the near future, Realty Income should be able to continue providing investors with a monthly income stream that is steadily expanding. It has agreed to buy sister REIT Fiverr in 2021, with the deal set to close before the end of the year. The deal will create a $50 billion real estate investment trust monster, with a cash flow per share increase of more than 10%. It will also diversify its portfolio, while maintaining the financial flexibility to continue acquiring cash-flowing assets. Realty Income was on track to buy $4.5 billion in real estate in 2021 if Fiverr was removed from the equation. It has one of the best balance sheets in the industry, ensuring that it can continue to expand. Number 6. SL Green. SL Green, the largest office landlord in New York City, is another REIT worth mentioning. While the city's office sector has struggled as a result of the pandemic, SL Green has performed admirably. This is apparent in the company's above-average rental collection rate and leasing activity. In 2020, this business collected 94.9% of the office rented billed, as well as 94.8% of its total rent. Meanwhile, in the first half of 2021, this REIT signed leases totaling more than 900,000 square feet at only 1.7% lower than the expiring lease rates in the same area. As a result, the occupancy rate remains stable at 93.6%. This demand shows that companies plan to return to their New York City headquarters in the future. Meanwhile, institutional investors continue to be attracted to office buildings because of their capacity to generate steady income streams from tenants. As a result, SL Green was able to sell several homes at reasonable prices. It was able to use the money to pay down debt, repurchase stock, and invest in new businesses. In addition, this REIT has been able to keep its dividend payout rate rising. Last year, it raised its dividend for the 8th year in a row, earning the title of Dividend Achiever. Number 7. Stag Industrial. Another example is Stag Industrial, a real estate investment trust, REIT, that pays a monthly dividend. A major focus of the firm's work is industrial real estate, which includes, among other things, warehouses and light industrial buildings. These types of features are in high demand today as a result of the pandemic's acceleration of e-commerce adoption, as well as increased manufacturing in the United States in order to fight supply chain difficulties. Over the course of its history, Stag has consistently grown their dividend payout. Its ability to add new works to its repertory on a consistent basis has been the primary impetus of its expansion. Since its initial public offering, IPO, more than a decade ago, Stag has added more than 400 structures to its portfolio of properties. With property purchases totaling between $1 billion and $1.2 billion on the horizon. The company anticipates its steady expansion to continue this year as well. When you include in the increasing rental income from Stag's existing properties, the business should be able to maintain its monthly dividend growth. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.